These are the most widely traded credit derivatives. It's an OTC derivative used to speculate on change in credit status or credit spreads. They're typically 5-year terms, and there's approximately $51 trillion in outstanding credit risks related to CDSs. That has grown 9-fold in the last 3 years and is up 300% in the past 12 months. Credit derivatives, to keep this simple, these credit derivatives are highly leveraged income vehicles sold to asset managers and investors all over the world. They're bundled packages of subprime loans and other forms of loans that are effectively worthless. They're based on the premise that the real estate market as a whole, and other financial markets will expand indefinitely. And of course, they're based on incredible greed. They're completely unregulated and massively, even fraudulently overrated by the rating companies. They are held by thousands of the world's largest financial institutions and investors, and $500 billion to $1 trillion in CDOs are likely, in our opinion, to implode in the near future. These SIVs and CDOs and CDSs are only the tip of the iceberg of a super leveraged debt pyramid now approaching $700 trillion. There are 3 flawed assumptions with the derivatives market. 1, that the value of the American home would never fall nationwide, projecting the immediate past, the last 3, 4, 5 years, into the infinite future. The second flawed assumption was that homeowners would always make their payments and would always be true to their financial commitments. You may delay payments on credit card debt. You may let even a car go, but surely you're not going to default on your home loan. You always have to have a roof over your head. Packaging mortgage loans and turning them into securities, this is the third flawed assumption. By packaging them, we should make the global economy more resilient if anything went wrong. And it's certainly true that by taking away some of the liabilities from an individual institution, by packaging them into derivatives and spreading them to other portfolios, no one institution will take the immediate fall or take the brunt of a loss. That just means they all will feel the pain to one degree or another. Now, the reality is that $2 trillion in repackaged loans were sold globally based on these ridiculous assumptions. The assumptions were flawed. Homeowners have been defaulting by the hundreds of thousands. And we're now in the worst housing collapse since the Great Depression. The Case-Shiller Price Index is down 14% in the first quarter alone. The problem of valuing these mortgage-backed securities or derivatives, no one knows what the real market value of $2 trillion in mortgage-backed securities is. It's not an active over-the-counter market. So how do you value the CDOs, CLOs, and CMOs or CDSs? Certainly not at par or face value, not in a collapsing market. For instance, this last December, E-Trade Financial had a fire sale on $3.1 billion worth of its mortgage-backed securities, $3.1 billion up for sale. They received between 11 and 27 cents on the dollar for their asset-backed securities. It's a 73 to 89% haircut. The last time we saw an 89% haircut before a major bankruptcy was when the Dow collapsed in the 30s, from 1929 to 1932. It left you with 11 cents on the dollar. That's the kind of values we're talking about in this market. Selling subprime assets at 26 cents on the dollar would hypothetically cost Merrill Lynch and Citigroup $9 billion, $26 billion, respectively, on an after-tax basis. There's huge risk to the major money center banks and wire firms due to their subprime exposure. Estimates of the real-world liquidation values of the majority of CDOs, SIVs, and CDSs of all types are between 11 and 20 cents on the dollar, and some, of course, are worth zero. The subprime crisis was, in fact, triggered by a collapse in housing. Between 2002 and 2006, trillions of dollars of mortgages were given to millions of buyers with poor credit ratings, and they could not afford the overpriced houses to begin with. They were hustled by profit-hungry real estate and mortgage brokers and tempted by very low interest rates, which would reset within a couple of years to 50 to 100% higher payments. The $11.5 trillion U.S. residential real estate mortgage bubble is now experiencing what we call reverse leverage. Already $1 trillion in losses have been recorded, and downward momentum is beginning to accelerate. At the peak in 2005 and 6, U.S. residential real estate was valued at an estimated $23 trillion, with about 50% of that mortgage debt being to the tune of $11.5 trillion. But that debt was then further leveraged by the big Wall Street investment banks and brokerage firms via the repackaging into CDOs, SIVs, and other credit derivatives, creating multiples, huge multiples of the $11.5 trillion, in other words, several hundred trillions of dollars in new credit derivatives before it was all said and done. Those derivatives then spread like an AIDS virus into tens of thousands of financial institutions worldwide. And it should be noted that this is global. We exported, perhaps the greatest export of this decade was our credit derivatives, and they now are in UBS, they now are in Deutsche Bank, and you see UBS taking $40 billion in losses between last year and this year. We're talking about a nasty, nasty little export. But Wall Street did a very good job at what they do. Meanwhile, Wall Street was raking in hundreds of billions of dollars in profits from the creation of history's greatest ever derivative bubble, while brainwashing the gullible public that perpetual asset growth, prosperity, and profits were virtually guaranteed. Wall Street, in collusion with the Fed and the U.S. government, has set the stage for the implosion of the gargantuan credit derivatives bubble, and indeed, perhaps the implosion of the entire world financial system. Moody's chief economist has forecast 2.8 million in mortgage loan defaults in the U.S. over the next 24 months. What will this do to the already rapid deleveraging, or reverse leverage, if you will, occurring in the multi-trillion-dollar mortgage debt pyramid? You think that the haircut you're seeing in real estate here locally, around the country, is severe. This is just the froth off the top. We have yet to experience anything as a result of an interest rate shock. So buckle up and hold on tight.